Hey everyone, and welcome to the Ncast. I'm Guy Weissmantel, your host and Executive Vice President of Marketing here at Ncontracts. In this podcast, our subject matter experts from across the company will be talking with industry thought leaders about relevant topics and trends in compliance and risk management for financial institutions. You'll learn the latest tips and tools to manage risk in this ever-changing environment. Let's get started.
Welcome. I'm Rafael DeLeon, Senior Vice President of Industry Engagement here at Ncontracts. And today, I'm fortunate to be talking with Elliot Eisenberg, an internationally acclaimed economist and public speaker who specializes in making economics relevant, educational, and fun. Who could ask for more when you got that combination? Dr. Eisenberg authors a daily 70-word commentary on the economy that goes out to 25,000 people a day. And if you'd like to be one of those people, as I have been, he'll tell you how to sign up later at the end of the podcast. Welcome, Elliot, and thanks for coming on.
Delighted to be here, Rafael. Thank you very much for having me.
Good. Well, I look forward to our conversation and bonding over some things about Florida and South Florida, and we'll go from there. But right now, there's a lot in the media about GDP. So what does GDP look like?
Wow, GDP looks great. This is going to be a banner year. Q1 that ended 3 months ago, roughly 6.4. Q2 we're now ending maybe 9.5, maybe 10. These are scary, great numbers. We may never see numbers like this. Hopefully, we never see them again. You only get them out of terrible problems. Q3 maybe 8. Q4 maybe 7. I mean, these are crazy strong numbers. We'll end up with a year of GDP growth of between 7, 7.5, 8. This will be the best since 84. That was the double dip recession coming out of the double dip recession of 81, 82, 83. Or the best since 1951, which was when we came out of the recession of the late 40s, demobilization. People left the army to go to school. Then they finished school and they entered the labor force. There was a very brief recession and then tremendous growth afterwards. So this is going to be a banner year. 22, lower, 23, still lower. And by the end of 23, we're back at normal GDP growth of 2, 2.25, whatever our economy can withstand. Maybe better than it was prior to the recession because of higher investment in corporate investment in equipment and stuff, raising labor productivity. But if this is going to be a 1 or 2, this is the best year. Wow, just enjoy it.
Great. So, when you see down the road that that's going to start declining, what are the factors that are going to impact that?
The reason I think we're hitting a peak. We're hitting peak fiscal stimulus. We're hitting peak GDP growth. We're hitting peak inflation. A lot of things, peak savings rates. Savings rates have peaked out, last quarter, but you get the idea. People's incomes are going to go back to normal because we're going to work for a living and so on. So the pent-up demand will slowly dissipate as we go out to eat and go to baseball games and boxing games and wrestling matches and opera. That'll go away. And things slowly return to normal. We've lived in an abnormal situation for the last 15, 16 months. It'll take 6 or 8, 12 months to get us back to normal, but we'll get there and then that's it. We're back to normal.
So taking about the 6 to 12 months getting back to normal, where does inflation play into that? There's been a lot of talk that it's an inverted V, and talk about that.
Can we ask the next question, perhaps, Rafael? That was a toughie. But kidding aside, if I could wear a T-shirt right now, it would say Team Transitory. Okay. Inflation's here. Inflation's bad. Inflation's going to go away. Look, you can look at it a couple different ways. Supply chain bottlenecks, well, they're bottlenecks, for God's sake. If they weren't bottlenecks, we would call them supply chain problems, but they're bottlenecks. You can't get a ship. You can't get a truck. You can't get a shipping container. You can't move a shipping container from Europe to Asia, Asia to US, whatever it is. You can't get workers. There are a whole bunch of problems, but these are all temporary. The labor problems go away September 5th when Labor Day hits and the unemployment top-off ends. The ships will get unpacked sooner or later. The longshoremen are going to stop having COVID. So manufacturers are going to get computer chips to make automobiles. This may take anywhere from 3 to 24 months, but these are all going to go away. That's problem number one. So the bottleneck problem. Okay. The second problem is a base effect problem. Look, you're comparing the price of goods and services today to where they were 12 months ago when we were in the middle of a friggin' lockdown. Look, last March or April, I forgot which month, I think it was April, spot oil prices fell to negative $30 a barrel. I mean, I was buying oil and dumping in my bathtub. Okay, maybe I wasn't, but you get my point.
Right.
So you look at these crazy prices a year ago, they're not indicative of anything. It's indicative of crazy low prices then, not high prices today. Now, and moreover, look, there's a lot of workers on the sidelines, for God's sake. 16 million people are filing for unemployment insurance of some kind or another, depending on the different programs that they qualify for. Before the recession, it was 5. I mean, that's 10 million, 11 million workers. I mean, come on. These people start filtering back in. Wage pressures are going to go away. Look, the biggest fear of inflation that I have is rents. And demand for housing is strong. People move out of their parents' basement, grandparents' basement, whatever. In-laws, God forbid. And the demand for housing is even stronger. Rent prices go up. So rent would be the thing that filters into the inflation that is a bit of a problem. But everything else, I simply don't see it. And the spending will come back to normal. Supply will go up. I mean, this is a classic problem of lack of supply. Look at the best example is lumber. Lumber demand isn't so great. If the supply was cut back and demand went up a little. So we're at 101 or 102% of normal. That small amount of increase is causing all kinds of problems because it's a very inelastic good. So this problem, demand goes down a bit because renovation work in your house goes down. That's the problem. They build a few more plants, sawmills, and hire some sawyers. The problem goes away. I don't see inflation being a problem. I really don't.
Well, that's good to hear. So, one of the points you just touched on there is about workers. And we see a lot of people on the sideline. We've seen, close to 19.5 million people that were unemployed at the start of the pandemic. I mean, huge numbers. And now you hear people talking about stimulus keeping people away from their jobs. Is that part of it? How did massive amounts of retirements or people quitting their jobs factor into that?
Nice comment. You get 3 points for that one. Retirements are a big deal. People did retire last year. People, in their late 50s, more so early 60s when they qualified for early social. People said, look, I don't want to expose myself to COVID. I lost my job. I'm taking early social. I'm out of here. We don't know how many people we lost that way, but it's a couple million. This is a meaningful number. So we don't know what full employment means when we get back to full employment, but there's certainly some of that. The unemployment top-up has certainly kept some people away. We can argue how many, but the way to think about it is this. We lost, I think it was actually 22.5 million workers, not 19.5. It was worse. We've gotten back 70% in roughly 12 or 13 months. That's wildly fast compared to any other recession. Yes, this one was much worse and much deeper and whatever. I get it. But normally unemployment takes a long time to go down. To get unemployment back to where it was or unemployment to come down takes a while. This was really fast. The last 30% that we have to get, that's at the top of the tree. You have to not only get a ladder, but you have to get a tall ladder to pick those apples off the tree. And those are harder. And they have kids who are home who they can't work because the kids at home. Maybe they have COVID, someone who has COVID. They're fearful they'll get COVID. The extra $300 a week really makes a huge difference to them because they're low wage workers to begin with. Maybe they have to change careers. Maybe they used to, fold pants at a Gap store. And now, lo and behold, no one needs to fold pants at Gap because you order it online from Amazon. The pants come unpackaged. I'm joking, but you get my point. So there's a lot of tumult in that last 30% of industry. And all these impediments are going to go away. The unemployment, COVID, vaccinations, we're going to get that. So that reason goes away. The unemployment goes away. The changing career, eventually you change careers. You can go back to your old job. All these, junior goes to school. We'll have plenty of workers available. They'll come back. It's short run problem, long run, no problem.
Good. I appreciate that. So how do I get counted in the numbers? Since I retired from the government after 32 years, but I'm now reemployed, where does that get taken into account for people?
So you're employed. You're employed. The question is, did you work? When they asked the unemployment question, they asked, did you work the week of the 15th of the month?
Okay.
So you may have taken a vacation between the one job and the next job. If they interviewed you that week, that month, you'd say, well, I didn't work that week of the 15th because I was on vacay or something. So you were unemployed. You were not in the labor force at that point. You were in the labor force, not in the labor force, and then you were back in and working again and in the labor force. And in the labor force means either working or looking for work. You weren't looking, you had a job, but
No, that makes it easier to tell my friends. So thank you on that.
Yes.
So again, one of the things that I hear about from my friends, and just kind of jumping ahead, is the economy's in deep trouble, despite what you're saying there, because they do the comparisons to tying two dots together that don't connect, but the Roaring '20s and Spanish flu, and saying that led then to the Great Depression. Is that realistic at all?
Let's think back. Back in the 70s, we listened to disco music.
Yeah.
Is that going to come back? No. We enjoyed polyester leisure suits. Anybody looking to get those back again? No. To take the fact that we had a pandemic 100 years ago and now say, well, that led to the Roaring '20s. Look, the time is completely different. There's nothing in common then and now except for the flu. And like the Roaring '20s, we're going to have a great 21 and a good 22. And then the party's over. We're back to normal. The average age in the US back then was about 10 years younger than it is now. We were 28. Now we're 38. Government debt was 10% of GDP. Now it's 110% of GDP. Taxes were coming down over that decade. They kept lowering taxes because things were spinning. Now we're raising taxes. No, don't take one isolated event. This also means that we're going to have a depression in 2029. We may well have a depression in 2029, but it will have nothing to do with the flu and anything that happened beforehand. It'll just be because the cycle hits a recession at that point. So I would just literally that's just bad thinking. It's lazy, sloppy thinking. No.
Good. Thank you. I agree with you on that completely. It's just
we're both wrong.
Exactly. Good. So again, you're very familiar with the housing market. And again, you and I were just talking. I just bought a place down in Florida, in Fort Lauderdale. I've seen those prices very crazy. I also live in the District of Columbia, where prices are very crazy. What are those things sharing in common right now? Is it just the demand for housing?
I've thought a lot about this, obviously. Yeah, COVID obviously injected a huge increase in demand, people who wanted to buy a second house. So I'll make fun of you here and say, well, really rich people like you who had a house in a dense urban environment said, hey, I got some money. I'm older. I can afford to buy a condo or whatever you bought in a more quieter, beachy community with lots of wind, and it's safer here. So I'm going to decamp from DC to move to Fort Lauderdale. Great. That's one reason. The second reason is interest rates, but I'm not convinced interest rates really matter all that much. Here's my take on this. What I think is really happening here is down payments.
Okay.
Younger generation, people under, say, 35, to us children, their desire is to travel. They don't save money like we save. When we were kids, our aim was to own a house. If you bought a house, when you between 27 and 33, you bought a house, that was a sign of success. You were doing things, the American dream, the rung on the ladder, first rung on the ladder. It was all going to be great. That was what you had to do. That was what society pushed you to do. And that's what were expected of us. Now it's to go yoga while stand-up paddleboarding in Bora Bora, while playing tennis with Roger Federer and experiential things. One's not better than the other, but what happened was during COVID, suddenly we started to save lots of money. And because we saved lots of money, we could afford a down payment for a house. We have had decent salary, decent income, but we didn't have that 10 or 20% for a down payment. But suddenly we saved $30,000 over the year because we couldn't go to Europe and couldn't do this. Let's buy a house. So there's extra demand for second homes, plus the suddenly ability of people to make a down payment who heretofore couldn't. Woo, big demand. And we don't build enough homes.
Right.
We're way underbuilt.
So even when you talk or look at new home sales overall, are they flat? Are they still increasing just to meet this demand? Where do you see things?
Home builders are struggling. I mean, I think that home sales will improve a bit. Builders are building homes and not selling them right now because they want to build the house and know what their cost structure in the house is before they sell it. Because in the early months when lumber prices and oriented strand board prices and plywood prices were skyrocketing, they were selling too early and they still had to build the house and they lost their shirt or made no money or whatever it was. Now they're smarter. So sales will improve. I don't think starts will improve a lot. It's just very hard to build a house now. You can't build anything at the low end. It's not possible to make any money building entry-level homes wherever you are, whether you're in El Paso or DC or San Francisco, even though the cost structures are quite different in all three towns. No entry-level homes. If you knock out the entry-level market, there's only so many more homes you can build. And there's rules and regulations that are out there that are making it hard. And buy right property is gone, and lumber is expensive, and labor is hard to get, and codes are bad, and impact fees are high. I mean, builders should be building their brains out at well over 2 million homes a year, and they're stuck at 1.5, 1.6. I mean, that's normally a decent number, but we're 4 or 5 million houses short. And at 1.6 million, we cannot make a dent in that bucket of deficit that we've got.
So that's really good, something good for our bankers to keep in mind with what they're looking at with these builders, instead of pushing them to sell, realizing that they've got to kind of catch up and look at their actual costs.
Right. If they're building spec homes, they've got to know their cost structures. It's very important.
Well, great.
Like car loans. Car loans also important. Car prices have gone crazy last while, right? Used car prices skyrocket. Don't lend against the blue book value of a car today, because in 2 years or a year, that price is going to fall down because of depreciation, which you know about. And then the supply of cars will go up. New cars will go up, and used car prices will come down. There's some weird off things.
Dynamics there. And I realize those shortages that you talked about with chips have impacted the auto industry. You drive by a dealership, you don't see many new cars on the lot right now, especially trucks.
Especially the high end. So that's exactly right. If you look at the official increase in inflation in new car prices, it's only 3 or 4%, which is not trivial. Don't get me wrong. It's higher than historical it's been. But used car prices, they're up 30% last month. I mean, 60, 70%. I mean, they're crazy numbers. And that's because there's no new cars. New cars, Ford especially, and some other companies have had particularly hard time with the chips. And they're trying to build their higher margin cars if they can. If they have a choice and they have the chips for free, they'll put them in an Escalade as opposed to a cheap, Fiat 500. Different car companies might, but you get my point. So the actual price of a new car has gone way up by much more than inflation, because it's the higher end cars that are being built and sold, not the low end stuff.
No, that makes sense. So just a little, with still looking at cars, the electronic vehicle kind of segment market that's coming on, do you see that there's going to be a wide adoption for it? Or is it just going to be kind of sporadic depending on, is it going to be more high-end buyers who are looking at that?
At the beginning, sure, it is now. Tesla's selling really well, but the average Joe, maybe you as a rich owner of a second home from a very high-paying, fancy senior SES government job, and I'm joking about all this. I have no idea about what you did and how much you make, so please. But they're selling well, but they're quite expensive. But yeah, absolutely, electric cars are going to do well over the next 10, 20 years. There's interest in the cars. My stepdad bought a car. I'm interested in buying a car. They're cool. They're neat. And there's going to be now, if Biden's infrastructure bill passes, they'll start to have gasoline pumps or electric pumps or whatever you want. Charging stations will start. And the charging stations itself will create demand. There's a chicken and egg problem here. Right. No stations, no cars, no stations. You got to break that logjam somehow. They are. Battery storage is getting cheaper. The cars are getting better. Yeah, this is an inevitable process. And the price of the cars are coming down. That's the biggest single thing. When you can buy an electric car for the same price as a combustion engine car, who would buy a combustion engine car? It's much less maintenance to buy a electric car.
So yeah, no, I perfectly know that well, because for the last 10 years, I've not owned a vehicle. And that has what saved me quite a bit of money.
Congratulations to you. You're on the avant-garde, man. Wow.
Okay. Well,
I take back my ridiculing of you earlier in our conversation.
Thank you. So kind of, again, looking at some of the other impacts that some of the bankers that may be listening will be impacting. Commercial real estate. They're involved in a lot of commercial real estate now, with a lot of talk that, especially in cities like DC or Chicago, LA, New York, where you have a lot of workers that are now working at home. There's going to be kind of a hybrid model. How is that going to impact some of these markets, or just commercial real estate, even in Miami? What do you
Okay, it's a great question, and one that I've, as you can imagine, probably thought a lot about. And I come down, the more I think about it, the more I think less will change. So a year ago, in the heat of the moment, back last May, June, when we were all locked down, well, we'll work from home forever. The office will die. Okay, that was clearly unrealistic. You look at some very good economic research. They ask people, how much do you want to work at home? And the consensus seems to be about 20 to 22% of office workers would like to do their work at home, whether it's people working full-time at home or 1 day a week at home, but about 20%. But then you realize maybe these questions are stupid. If I asked you, Rafael, hey, would you like to get paid twice what you're making without having to work anymore? You'd go, yeah, I'd like that. I mean, you ask a dumb question, you get dumb answers. So I'm not sure that these questions, these survey questions are really meaningful. I think two things are going to happen. One is as people go back to work, people who don't go back to work are going to suffer. Because let's say you're my boss, Rafael, and you're a very shallow, thoughtless person. And I know that if I suck up to you every day, I'll get the pay raise and I'll get the promotion. And my friend who works at home, out of sight, out of mind. When we're all at home, it doesn't matter. We're at home. But if half of us are in the office sucking up to their bosses and half of us aren't, the half that aren't are going to want to get back to the office. Number one. Number two, labor productivity was really high this past year because we had nowhere to go and nothing to do. If you're home now in the new post-COVID world where you can go to a basketball game and you can go traveling and you can do this, staying at home is much easier to get off focus by being at home. So it wouldn't surprise me if labor productivity numbers actually began to decline from where they were over the last 12, 13 months. That may be an aberrantly high labor productivity number. So I suspect people come back, but, and this is where it gets to your question directly. C quality office space, B quality office space, I'm not sure those are going to make it. You want to build cell phone towers, warehouses, logistics, last mile stuff, that kind of stuff. Yeah, we're fine. Self-storage, medical, pharmaceutical development. There's a big demand for that. But B quality office space and C crappy air conditioners, mold in the buildings. I don't know about that. So I would be most concerned about that class of real estate. Commercial, industrial is going to be fine. Res is going to be fine. Rental, multifam, it's all fine. Maybe take 6 months because of the moratorium, eviction moratorium. There could be some here and there problems, but no. It's just those lower quality office buildings that I'm most concerned about.
Right. So if people are looking at doing that, or companies looking at relocating their office, they're going to migrate to a Class A building, especially if they're given concessions on rents or anything else.
You bet. Yes, sure. That's right. And the concessions are going away, right? They're not as big as they were. I spoke to a couple of folks looking for rentals in New York City. They could have gotten 3 or 4 months rent a few months ago. Now it's down to 1 month. So things are returning. Think back to every recession. Last recession, 09, 08, 09, the notion was, millennials, those guys, whatever, they're never going to buy a car. They bought a car. Then it was, we're going to use buses. Yeah, they're going to go and take buses to work. Now no one wants a bus. What's going to happen in 2 years when we do this again? People will be riding a bus. Don't extrapolate from the current to the future cavalierly. It's very risky and usually very wrong.
Well, no, I usually see a lot of things like that. But I'm going to make a jump on it. One of the other questions that, I hear from a lot of people and kind of you see in a lot of news, Robinhood or retail investors, how has that impacted the stock market? It just seems like, some of these are like going to Vegas or, again, with some of these meme stocks, there's no fundamentals. How is this structurally changing, the markets right now, or how people are looking at those?
It's a great question. I think it's two extremes. On one hand, it's changed it a lot. On one hand, it hasn't changed it at all. On one hand, you look suddenly AMC and GameStop and a couple other ones, BlackBerry. There were a couple other names like Hertz. I can't remember them all. These classic or traditional meme stocks after a few months of it, they've done really well, or they've gone on a crazy ride. But they haven't fundamentally altered the price to earnings ratio of the overall index, overall market, right? I thought way back when, which is a couple months ago, which is forever in meme stock history, that meme stock volatility might lead to a stock market decline. We see all these stocks doing badly, then we're covering, we sell stuff to cover, whatever. There's a bad domino effect or something. Didn't happen. No one seems to care. So it's isolated to this weird market part of the market where there's well-known names that have encountered a difficult situation and people are playing against those games. But I don't think at the other end, I don't think it really matters all that much. People like you and I aren't being carried away. Some money is being carried away. It's not a lot. They will lose their money over time. They will learn that the market is not a one-way up conveyor belt, and it'll end. But in the short run, it's changed, I think, permanently. What this has done is it's changed why we invest. Heretofore, we generally invested to make money. Now we invest to join a community. So now I'm on Reddit, one of those important Reddit, is an important platform. And there's a certain piece of Reddit where they talk about, what they're doing. Now I buy AMC stock so I can say I own 100 shares and I'm going to hold it to the moon and I have glass hands and hodl and all these words and phrases, and you're excited and you tell your friends and you share with your gardener. And there's a piece of investing, that the sociological part of investing, that we've never cared about. Our generation, I didn't care about green. I didn't care about all these things, but suddenly they matter. And it's altering a little bit about how we invest. And maybe as these people age, they may take some of this with them in some shape, way, or form. Although I doubt it. Remember 10, 12 years ago, the day traders, and back in 5, 6, 7, they kind of went away when the going got rough. So, but this reason to invest has certainly changed, and we should be aware.
So just in terms of that I don't want to say fear of missing out, but being a part of the community, is that same analogy would apply kind of to Bitcoin or any of the cryptocurrencies where people are?
Cryptocurrency too is a very similar thing, where you want to own it just to own it on one level. And there's also the excitement, and it's exciting. Like AMC may be exciting, or GameStop, but Bitcoin's really exciting because it's really expensive. It's 60,000. Okay, now 35,000 or whatever, but it's exciting. And I'm not convinced there's, look, I'm not a big gold fan. I think gold is a bubble that's been around for 10,000 years. Bitcoin may well join that as a bubble going forward for the next 10,000. I don't know, but yeah, it's a community. You're talking, you commiserate together, and you enjoy the experiences together. In the old days, when we were, when we are adults, our mentality is, well, you don't share with other people your financial successes because you don't want to get people jealous. You don't want to brag. That's bragging. That's braggadocio. That's just a wrong thing. But if it's Bitcoin, it's different. Somehow the veil of secrecy is lifted if it's Bitcoin or a meme stock, not if it's Google.
Right. So again, as we're kind of winding down, and one of the things I'd mentioned to you early on, I want to talk about is some of the headwinds impacting banking. And we've talked about some of those. We've talked about real estate. We've talked about commercial real estate, price of lumber, new home builders, all these other things. What do you see in terms of really one of the biggest headwinds I see, and as a former regulator, the compressing net interest margin? How are banks dealing with that?
It's tough to be a banker. God bless you all. Your ROA is tough. Your loan to deposit ratios are crummy. The yield curve is tough. And I think if inflation doesn't come back, which I've talked about earlier, I don't think it does. I think we end up in a bull flattener situation here, right? Interest rates are going to come down. 10 years way down. It's a 1.3 today. I mean, wow, or 1.4. It's really fallen. I think we've realized peak growth, peak inflation, peak stimulus is right now. And as we go forward, economy will grow more slowly. Inflation will go away. I think the bond market really has got the story reasonably right here. So the bankers have to be thoughtful. They have to be, on the lookout for merger opportunities or to be merged into something, because smaller institutions have a harder and harder time now with more cyber issues out there and the cost of cybersecurity going up, and legal issues are more expensive and costly, and money laundering stuff. It's hard. This is a tough industry. And you're hearing from Capitol Hill that they're angry at you about making too much money on overdraft fees. It's a tough environment out there. I think you got to figure out what you're really good at and do it well, whether it's making car loans or home loans or whatever it is. Figure it out, stick to your netting. Maybe credit cards are where you're successful, terrific, but be careful. Don't extend yourself too much. It's a tough place. It's a tough market out there right now. Competition's it's rugged.
Right. So what you're saying is some of the same things I've said to bankers, and I will continue to talk about, is how they're going to remain relevant. What is it they do, and how do they position themselves, and what niche or other products are they very good at that they stay with? But how do they address that? Not just we're going to go after every little fad. We're going to chase Bitcoin. We're going to change meme stock. We're going to. So yeah, and you agree with that?
I wholeheartedly agree. The economies of scale in this industry are unrelenting. Bigger sizes make more money. And you always have to keep that in mind. And if you're small, maybe you put on lipstick and you show a little leg and you get bought out, and that's your strategy. Maybe you're a bigger guy and you want to, or bigger gal, and you want to buy some smaller fry. Great. there are other approaches here too. That's an easy one, is to buy or be bought. And that's risky too, because it doesn't always work out so easily, right? It doesn't always work out so well. And keep in mind where you're located. What is it that what's the risk you can't diversify away from? If you're in rural Iowa, I'm making it up, ag is really important. You have to really keep this in mind 24/7. Ag prices bounce. All your deposits are going to be up together or down together. How do you diversify away that risk? Maybe you open a branch in Des Moines, Sioux Falls. I'm making it up, but diversification also helps. But doing what you do well is really important.
Well, banks are sitting with a lot of liquidity, on their books right now because of fear of what was going to be going on in the stock markets. And we've seen these kind of fears ebb and flow. And do you think that all of a sudden now, because of low interest rates, people will jump out and chase some of these other opportunities that we just talked about, whether that's crypto or meme stocks, whether smartly or not, and some of this liquidity will be gone?
A low rate environment clearly causes people to do stupid things. This is the big fear the central bank has, right? It's why people are all, we like the low rates, and it's probably the right call, we could argue, but it causes very strange behavior. And it's the impact of that strange behavior and yield chasing that makes us all afraid of the next recession. Where are we creating the bubble that will cause the next recession is the fear that's out there. But we did see, the reverse repo that the Fed has a reverse repo facility, and they raised the interest rate on that from 0 to 5 basis points. Woo! And what happens? $750 billion floats into this reverse repo facility, overnight reverse repo. And people like me go, I don't know what that means. It means there's lots of liquidity, fine. But do we care that this hot money can just bounce around like that? What if it all goes into meme stocks? I mean, it's not going to. This is bank money owned by banks, right? But it makes me a little nervous. Let's put it that way. I'm not really nervous. I'm not sure if I even should be nervous, but in my gut, my spidey senses say I'm a little nervous.
Well, as a former regulator, having worked through the crisis in the late 80s in Texas, the dot-com in 2000, and what we just saw here post-2007, 2010.
You've earned your gray hair.
Exactly. And what you typically see is with bankers, it's that anxiety for income. When there isn't other income coming in, it's making some choices that they weren't planning on.
Right. You don't expand your lender box, your loan box in the wrong area. Right. Really think through. The other thing to think about down the road is crypto, official crypto, Federal Reserve cryptocurrency. That, 5-10 years down the road, that may well show up here. You should have a committee sort of beginning to think about that down the road, what that means to us, how are we going to do it? I mean, the Fed's not going to destroy the banking system. They're going to be very careful not to do that. That's not the aim here. But you're going to have to interact and figure out how that's going to cost you money and how are you going to do that and how is that going to affect your cost structure and so on and so forth. But that will be something to think about over the next while.
Well, Elliot, I think that's all the time that we have. I really enjoyed meeting and talking with you today. And I look forward that maybe we could have another conversation down the road.
I'd be honored. Absolutely.
So before we leave, can you tell people how to sign up for your blog?
Oh, thank you. Yes, I'd be delighted to. So I put out 70 words every day on economics. No graphs, no ads, no charts, no links, no photos. Monday through Thursday is very serious economics. On Friday, it's just plain funny stuff. So the way to sign up is really easy. There are a couple ways you can email me, but the easiest way is to text the word bow tie. Imagine that, bow tie, to the 5-digit number 22828 or 22828. Bow tie, one word, no hyphen, no space, just 6 letters. And if you do it right, you'll be prompted for an email address. You'll hear from me every day till you die. You cannot unsubscribe from this number. Okay, maybe I'm lying. You can, of course. But bow tie to 22828, and you'll be subscribed. And I look forward to having you as a subscriber and reader. And those emails are live. You can respond.
No, thank you. Again, thank you so much, Elliot. Appreciate it.
My pleasure. Thank you so much, Rafael. I look forward to next time already.
Hey everyone, that wraps up another great episode of the Ncast, where we are able to talk with people on the front lines of risk and compliance across the financial services industry. If you liked what you heard, please leave us a review. And if you're not subscribed yet, we invite you to do so on your favorite podcast platform. Thank you so much for listening, and we'll see you soon.